look, a lot of folks have been all in on the Magnificent Seven in the last 10 days, have certainly sparked renewed interest that those companies will continue to radically outperform basically any other companies in the world. And look, 7 companies can be in a bubble for longer than any of us can remain solvent. And I think the real question is, what is your time frame? What is your time frame to think about how you want to allocate your capital? And if you're allocating on a day or a week or a month, look, chasing bubbles may be the thing that attracts you. But if you're thinking about how do I prudently allocate capital over a multi-year time frame, then you start to have to meaningfully consider the discontinuity of valuations that exist across the U.S., within the U.S. equity market and across the world. That's really what I'm highlighting here. If you go to the right-hand side, the right-hand chart, I think it's pretty interesting to see just how much re-rating there has been of the S&P 500, how little re-rating there's been of the S&P 500, right? That's what you see is basically the S&P 500 PE today is basically, next 12 months PE today is basically where it's been on average over the last 10 years. Now, to be clear, interest rates today are radically more elevated relative to where they were over the last 10 years. And so you would not expect to have the same earnings yield. You would expect to have a much higher earnings yield, given the fact that real interest rates have gone from negative 100 basis points to positive 250 basis points, right? A huge 350 basis point increase in real interest rates should lead to a higher required earnings yield on your stocks. But nonetheless, when you look at the S&P 500 as a whole, what you see is you basically see an unchanged earnings yield over the period for the large cap equity market. But that basically is the only place where you see those sorts of dynamics. If you look across other areas of the U.S. economy, basically, if you look to smaller cap companies, you've had a meaningful adjustment, even considering the weaker earnings growth that exists for those companies. And so you look at the S&P 600 or 400, et cetera, and you see that they've been meaningfully re-rated, unlike the rest of the mega caps. And then you look around the world, and what you basically see is you see the weakest sentiment for non-U.S. stocks that you've seen in decades. On the left-hand chart, what you see is the difference in the equity risk premium between the U.S. and Europe, which is basically at 30, 40-year lows, meaning that your U.S. stocks are meaningfully more expensive than those in Europe. You're getting almost double the earnings yield in holding European and UK stocks than you are in holding U.S. mega cap stocks. And then you also see it in the middle chart there, where the sentiment on emerging market stocks is basically as weak as it's been since the financial crisis. And so, if your time frame, think about how do I construct a portfolio over a couple year time frame, and you're thinking about what sort of equity exposure do I want, you really have to start thinking about these areas outside the US in terms of their valuation and how extreme the divergences between US mega cap tech stocks have been relative to how it's being priced in the rest of the world.